Welcome, dear traders. You're watching a recap of the Asian session. Yesterday, Wall Street saw a meteoric rise. So, stock indexes soared to monthly highs, and European, Japanese, and Australian shares climbed as well. What factors influenced stocks and currency pairs? Watch our video review and find out. Let's start. Risk appetite remains high, mainly amid expectations of a smaller rate hike by the Fed. Traders anticipate only two more rate increases by 25 basis points. In this case, the interest rate will reach 5% by June. After that, speculators expect two rate cuts by 25 basis points until the end of 2023. At the same time, the Fed keeps making hawkish remarks, saying that it could even hike the rate by 75 basis points. However, several Fed officials spoke in favor of a 25 basis point rate increase last week. They assume this is an appropriate pace of a monetary tightening. The Fed and investors have different expectations of a monetary policy prospects. However, neither of them really knows how the situation may unfold. For finance, the economy has started to cool down. It's confirmed by many indicators, including a recent fall in inflation. Janet Yellen sees very helpful signs on the US inflation front. The market reaction to such an optimistic comment was immediate. The CME FEDWATCH tool jumped to the level of 100%. The US dollar has been rising amid the Fed's hawkish policy for almost the entire past year, and so for the greenback, a policy reversal is a bearish factor. It appears the US currency is sliding into a bear market. The US is no longer the cleanest shirt in the global economic laundry, Ray Attrill, an analyst on National Australian Bank, stressed. He believes that the US dollar will fall sharply in the near term. Apart from a monetary tightening, there are plenty of other reasons for a downward movement, besides traders priced in rate hikes a long time ago. The euro climbed in the morning following the ECB's hawkish comments. The yen is likely to assert strength too. It may finally break out of the bearish channel in the coming months instead of quarters. The US dollar index sank to a 9-month low against the euro and lost its recent momentum against the yen. It declined by more than 1% and broke through the horizontal support level of 102 points, which turned into the resistance level. In the Asian session, the greenback rolled back to 101.80, trading in the downward channel of 101.70 and 102.00. PMI data, which will be published in the afternoon, will barely affect the trajectory of the greenback. Japan has already unveiled its PMI index. It has been contracting for the third month due to weak demand and the steady decline in production and in new orders. Uncertainty in the Japanese markets is mounting amid talks about the new Bank of Japan governor. Given the current economic situation in the country, speculators assume that it's a time to revise the monetary policy, and this is why they are betting on a policy reversal in the near future. However, the regulator sticks to a dovish stance and does not intend to make any changes. So, the dollar-yen pair took a breather. Besides, a drop in demand for safe haven currencies affected both currencies. After reaching 130.89, a 3-day high on a Monday, the pair started a correction. In the morning, it was steadily dropping in the price corridor of 129.70 and 130.70. If the pair breaks through the 129.00 level, the bulls will be able to push it to 127.80, the low of January 19. After that, the price could touch 127.20, the low of January 16. In the case of a rebound, the pair is likely to test 131.60, the resistance level locked on January 18. Its breakout could trigger a rise to 134. In the Asian session, the bulls retained control. As a result, the pair approached 129.90. Commodity currencies resumed growth amid the fallen US dollar and improved risk appetite, although trading floors in China are closed this week on the occasion of the Lunar New Year holiday, and the reopening of the economy still facilitates an increase in the commodity markets and currencies. Many Australian goods have already significantly increased in price, boosting the Aussie. Investors also took notice of the positive comment made by Treasurer of Australia, Jim Chalmers. The politician is hopeful that the worst of Australia's inflation crisis is in the rearview mirror. The Australian dollar was also up after oil prices jumped to a 7-weekly high. The Aussie was aiming at 0.7063, it's a 5-month high in the morning. In the Asian session, the AUD-USD pair was trying to consolidate above the resistance level of 0.7040. Eventually, the pair rolled back to 0.7027. Nevertheless, it kept moving in the green corridor of 0.7020 and 0.7053. The Aussie maintains an upward momentum versus the US dollar. A strong rally on Wall Street also bolstered the New Zealand dollar. In addition, former COVID Minister Chris Hopkins will replace Jacinda Ardern after her unexpected resignation. He is expected to be endorsed tomorrow. The new Prime Minister promised to focus on economic issues, including inflation, and the Kiwi was able to recover amid positive political news. The NZD-USD pair was trading in the upward channel of 0.6480 and 0.6523. It touched the psychologically important level of 0.6500. And that's all for now. Subscribe to our channel and keep close tabs on the market developments. See you soon.